Grog has a dilemma. He has shiny rocks to invest, but the tribe elders are shouting in both ears. One side yells,
"Get paid today."
The other side shouts,
"Get rich tomorrow."
"This is the ancient war between dividend stocks and growth stocks."
But first, Grog is happy you are here. He asks you to please smash the like rock and subscribe to the tribe. It helps Grog find more shiny stones. Done? Good.
Warning, Grog is not an advisor. Do not listen to Grog for financial advice. He is a caveman. Imagine owning a big, lazy cow. You don't need to sell the cow to make money. You just milk it every month. That milk, Dividend. These are companies like Coal India, Indian Oil, huge, heavy money printing machines. They have conquered all the forests. There is nothing new to fight, so instead, they share their profits with you.
We measure this milk with dividend yield. If a stock costs 100 rupees and pays you 5 rupees a year, that's a 5% yield.
It's safe. It's the only job in the world where you get paid just for breathing. But beware of the yield trap. So, what is a yield trap? Remember the math. Yield is the dividend divided by the stock price. Sometimes the yield looks huge, not because the company is generous, but because the cow is sick and shrinking. If the stock price crashes to 10 rupees, that same 5 rupee dividend looks like a massive 50% yield. Grog thinks he found a deal, but he is actually buying a disaster. A high yield on a dying company is still a dying company. Now meet the growth stock. This is not a cow. This is a hungry T-Rex. Grog comes with his bowl.
Where is my milk?
No milk. I drink the milk to get huge.
This sounds bad, but it is true. Growth companies like Zomato or InfoEdge don't pay you anything. Every rupee they earn goes straight back into the business.
They build software, factories, AI, and you get zero cash today.
So why buy them? Capital appreciation. You're betting that your T-Rex will help you hunt faster and make you king of the jungle, aka millionaire.
For example, if you had bought this share early, you wouldn't have received any dividends, but you would have become rich.
So Grog asks, which beast is better? The answer is neither. It depends on who Grog is and what Grog needs.
If Grog is an elder who needs shiny rocks today to pay for his cave rent and medicine, he chooses the cow, dividends. It is steady and safe. But if Grog is young and has a job, he doesn't need extra cash today, but he wants to be the king of the financial jungle in 10 years, he bets on the T-Rex.
Here's where Grog must pay attention. Dividend stocks. Each time Grog gets milk, a government spoon appears. Relax, Grog, I just take a sip.
This is called tax drag. It slows your wealth growth every year.
But with growth stocks, you pay zero tax until the day you sell, when you pay capital gains tax. Your money grows undisturbed.
But smart investors choose total return, a mix of steady milk and giant monster growth.
But Grog asks, is there a cheat code? Yes, it is called the growth plan. In India, we have growth, mutual funds, and ETFs.
Here's the magic. When the company pays the dividend, it does not hit your bank account.
Instead, the fund manager takes the dividend and immediately puts it back into the fund to buy more shares.
Since the cash never touches your hand, the income tax levied by the government cannot touch it. The price of your pot, NAV, just gets bigger.
You only pay the capital gains tax years later when you finally sell. It is the ultimate hack. You get the growth without the tax drag.